Are you new to investing into real estate or considering investing into real estate and want to know how to run the numbers on a property to see if it makes sense for you? Then in this video, I'm going to share with you how to do a financial analysis on a property to see if it'll make sense for your investment portfolio. So let's dive into the numbers, where I've created a spreadsheet for you to download for free that you can work along with this and use for your own reference for whenever you are analyzing your own properties. Quick disclaimer, I am not a financial advisor or wealth advisor. I'm a full-time realtor that helps people with sales and purchases. I've created this to work with investors to analyze properties on a financial basis, and that is all. Let's get back to it. First thing we're going to do is look at a cash sale with more simple terms. Then we'll add terms that are going to be a little more complex that you will want to consider when you're really looking into potentially buying an investment property. After that, we'll pivot to a financed home model and how those numbers are calculated a little bit differently. When we're looking at a cash purchase sale, basically the way that we're going to calculate the return is look at how much the home actually costs us to acquire, look at our overall expenses, look at how much rent we're taking in, and we're going to put those numbers in a ratio, and that's going to give us what's called a cap rate. And we're going to use that percentage as a measurement of what type of return to expect. Let's take a look now. Now let's look at everything that's included in the total acquisition price. Of course, we have the sale price, and we're going to use for Orlando a little bit above average, and for round number's sake, we'll say $499,000 sale price. Since it's a cash purchase, there aren't going to be many closing costs. We'll call it $1,000. Again, bringing us to a total acquisition price of $500,000. Down here on expenses, things that we know we're going to have is taxes and insurance. This is calculated for you. We're just estimating it at a 1.3% rate based on the purchase price. This will vary depending on where you are in whatever county or state you're living in. You want to look at your local tax records, right? Pull up your local county property appraiser, type in the address, and that will pull up what the taxes were for that property in the most recent year. Then you'll have insurance. Here in Orlando, for this size home, it might be about $3,000 per year. So I'm just gonna put that in as $3,000 manually, and that gives us our total expenses. Now let's look at the income. When we're looking at income, we wanna first factor in what we might get for rent, and that might be $3,500 per month. That'll immediately calculate to $42,000 per year if every month is rented, giving you a gross income of $42,000. But income subtracting the expenses gives you a $32,513 net. So if you divide that net into how much your acquisition price was, the $500,000, that will give you a percentage, which is 6.5%. That is a 6.5% cap rate. That's your number for a cash sale in this scenario. However, there are other things you want to look at if you're looking into more details, such as maintenance costs, such as landscape, property management, tenant placement, HOA fees, and pools. Those are all variable things that differ between properties. It's a smart idea to assume there might be some repairs. Let's call that $1,000. Landscaping, sometimes tenants want to handle that. Sometimes there's no landscaping, like a condo. Or sometimes the landlords want to maintain the landscape themselves to make sure it's done right. Assume you're doing it yourself and it's $120 per month. Then property management. Let's assume it's your first property and you're okay managing it yourself, so that's going to be $0. But you want to hire a realtor to do a tenant placement. That could be equal to 1 month rent. So we know that's about $3,500. Then HOA fees, if you're in an HOA community, you'd add that. And if there's a pool, who's going to maintain the pool? Is it the tenant or you? Those are things to be negotiated. Assume there's no pool, so that's $0. So you can see how these also factor into your total expenses, increasing how much it's going to cost to maintain that property, and that will decrease the cap rate when you add those in. So this looks like a 5.31 cap rate in this scenario. So a $500,000 house, bringing in rent of $3,500 a month with landscape and a little bit of repairs factored in, and tenant placement or a month vacancy, things like that, gives you about a 5.3% cap rate. Now let's look at a financing model. If you're learning anything and finding this helpful, please consider a like and subscribe. It helps us out tremendously and helps us continue making content for you. When you're looking at calculating the return for a home, if you're financing it, there are a few other things to consider, such as the mortgage payment or principal and interest. Then, of course, you're not putting down as much cash since you're financing, so it's only a percentage of the purchase price in cash. So we have to calculate all of those things. Similar as a percent return, but we're going to call it a cash on cash return instead of a cap rate. Let's take a look. So here in this model, we're going to use the exact same priced home, $499,000. Because it's financing, there are closing costs with financing, and we're going to estimate that as $10,000. We're going to use a down payment of 35%. That equals here $174,650. And with that, we used a 7% interest rate for a 30-year fixed loan. If there were renovations, you'd add them here. Here's your total acquisition price, $184,650, much less than $500,000. Now let's look at expenses. Basically, the same things that we had before, but we're adding in the principal and the interest, which is your mortgage. I used a financial calculator to calculate this. It's $2,162 monthly. For the year, it comes out to $25,000. So it obviously adds a lot to your expenses for the year. So expenses are $41,371. With rent, the exact same as the other house, $42,000 for the year. You have your net of $629. So if you divide that $629 into your total cash, which was $184,000 and change, that comes out to a 0.34% cash on cash return. So we just looked at this financing model with 35% down, and that barely gave us any cash flow. So we're going to look at it with putting more percent down. Let's look at it with 50% down payment, or half. And since we're doing a higher percentage down, we're going to assume that we're going to get a little bit better interest rate of 6.5% instead of 7%. When we do that, here's what the numbers look like. The percent down is 50, so it's $249,500 is what we're financing. And our principal and interest, the mortgage, decreased to $1,580 per month. And that gave us a little bit less expenses. Rent stayed the same, so it gave us a higher net. So we divide $7,613 into our total acquisition price of $259,500. And that gives us a return, a cash on cash return of 2.93%. Now let's look at this same financial model where we're doing 50% down, but assume it's a short-term rental. When we do that, we're going to assume that the short-term rental brings in more income per month. So we're going to increase that to start. From $3,500, we'll increase that to $5,000 for an average monthly income, but we know that's probably seasonal and that'll vary month to month, but we're going to use $5,000 as an average. Then, since we're busy with work and we don't have time to manage our own property, we typically hire a property manager for short-term rentals. So we're going to factor that as a 20% fee of the rental income. So if rent total for the year is $60,000, that comes out to a $12,000 property management fee, or $1,000 a month average. Additionally, to a property management fee, property managers for short-term rentals typically charge a monthly fee as well. Let's assume that's low at about $100 per month. And then usually these short-term rentals, especially in the Orlando area like here, they're in a HOA community that also has like a pool or some type of amenities to attract the short-term rental vacation homeowners or short-term rental vacationers. So we're going to assume there's an HOA fee of, let's say, $250 a month, which would be fairly low. So when we add all of these new factors in, additional property management fees, HOA fees, and the monthly management fees, then it gives us a much better return at 5.44% cash on cash return. So there are two schools of thought here. One is have no debt, own your properties outright so that you're not financing. And the other is leverage as much as possible. So in this scenario, with a $500,000 house, which school of thought would you fall under? Would you want to own a property outright at $500,000 all cash, or would you leverage, and let's say you put $250,000 down, or 50%, and buy 2 properties? Let me know in the comments. Type number 1 if you're in the all cash, and type number 2 if you would finance 2 properties at $250,000 each. And if you're up for it, let me know why. It might seem obvious that the short-term rental produces a higher return, a higher cash on cash return compared to a long-term tenant. And it might seem obvious that the cash example gives you a better return than financing right now. As you can see, we used today's interest rates, which is about 7% for a financing home. Then it really eats into someone's margin for getting a return on their investment. This helps explain why that sector of the real estate market, especially here in Orlando, is experiencing a slower turnover and more inventory is coming to the market. It's becoming more of a buyer market because interest rates are higher. That being said, people with cash are still finding pretty good deals, and it still makes sense for some people to invest in real estate, even with higher interest rates. Again, not all people have to finance or they put a bigger percentage down. Another reason that people may still buy real estate in today's market is diversification, or they just like real estate. There's only so many places that people can invest their money. There's stock markets, there's 401ks and retirement accounts, there's other businesses or people, and then there's real estate. Real estate's nice because it's tangible. People can see a home, they can live in a home. People always need to live somewhere or have a roof over the head. They don't always need to own stock in GameStop or something like that. So again, people like real estate because they get passive income while they're renting the house to someone else. Then that home can appreciate over time, and over history, it appreciates quite a bit, and it's pretty consistent. So people enjoy that built up equity over time. And if you're financing, it's really nice if your tenants are paying that entire bill for you, allowing you to increase equity on your tenant's dollar instead of your own. If you've made it this far in the video, then thank you very much. I hope you learned a ton. By the way, this is not a typical video that we produce. Usually we're making a really high production community tour or area overview tour that allows people to navigate the real estate market here. And those are going to be amazing. If you want to check those out, I hope you do. Thanks again for watching, and we'll see you on the next one.